everyone for joining us today. The slide deck can be found in the handout section of your webinar toolbar. Please use the question section on the right-hand side to ask questions throughout the presentation. We understand that we may not be able to cover all of your questions during this presentation. We appreciate your patience. We will also be sharing the slides and presentations video recording link following the live presentation.
All right, welcome everyone. Thank you for joining us today. My name is Lisa Galinsky. I am an Associate Quality Control Principal at Witham. I am here today with Jennifer Stewart, who is also a Quality Control Principal, and Stephanie Nissen, who is a manager in our not-for-profit niche. Our presentation will include an accounting and auditing update and a discussion on avoiding common accounting pitfalls. Next slide. The accounting and auditing update will include a discussion on the new presentation and disclosure requirements for contributed non-financial assets, reference rate reform, goodwill and other intangible assets, new auditing and review standards, and measurement of credit losses. We will also be discussing some accounting topics where we tend to see accounting errors. This includes the determination of whether a transaction is an exchange transaction or a contribution, revenue recognition for conditional promises to give, classification of net assets, present value discount for unconditional promises to give, functional allocation of expenses, and accounting for non-financial assets. We are not discussing the new lease standard today because there is a CPE session next week on Tuesday that covers that topic. Next slide. We keep going. As I just mentioned, our first topic for today is ASU 2020-07, Presentation and Disclosure for Contributed Non-Financial Assets. Next slide. Accounting Standards Update 2020-07 provides rules for the presentation and disclosure by not-for-profit entities for contributed non-financial assets. The standard was issued with the intent to make reporting of contributions of non-financial assets more transparent in a not-for-profit entity's financial statements through enhanced disclosure, especially non-financial assets that the organization uses in its programs and other activities. Transparency is important because many not-for-profits receive and use many different types of non-financial assets in their programs and activities, and non-financial assets can significantly affect key metrics used by grantors, donors, watchdog agencies, and others. The FASB was receiving concerns from state charity regulators about the valuation of certain pharmaceuticals, the impact that valuations were having on financial statements and related metrics of some not-for-profits, and the overall lack of transparency related to contributed non-financial assets. In addition, if a not-for-profit relies on the receipt of significant amounts of contributed non-financial assets that can potentially affect a not-for-profit's programmatic and financial sustainability. For instance, if a not-for-profit normally receives a significant amount of contributed non-financial assets, and all of a sudden there is a significant decrease in the amount of non-financial assets received, the not-for-profit would then either need to use other resources to pay for the assets or services that are no longer being donated to them, or they would have to make cuts in the programs that rely on those donated assets or services. The choices the not-for-profit would have to make if there was a decrease in the amount of non-financial assets received and the ramifications of those choices is of interest to lenders, grantors, and other key stakeholders. These are the reasons why FASB issued this ASU. The ASU didn't change any of the accounting rules related to contributions and non-financial assets. It only changed how contributions and non-financial assets are presented in the financial statements and disclosed in the notes. The definition of a non-financial asset is an asset that is not a financial asset. A financial asset consists of cash or contractual right to receive cash. Non-financial assets include land, buildings, equipment, use of facilities, equipment or utilities, materials and supplies, intangible assets or services. For services, these would be services that meet the criteria for recognition as contribution income, which is they create or enhance assets that are not financial in nature, or require specialized skills are provided by individuals with those skills and would typically need to be purchased if the services had not been donated. Common types of donated services that meet this criteria include architects, teachers, lawyers, accountants, doctors, and construction services. Next slide. The ASU is effective for annual periods beginning after June 15, 2021, and for interim periods within fiscal years beginning after June 15, 2022, which means it's effective starting with fiscal years ending on June 30th, 2022, which is almost here, and interim periods starting in fiscal years ending on June 30th, 2023. Early adoption is permitted. When this ASU is adopted, it must be adopted on a retrospective basis because the FASB believes it's important for trending information to be comparable. Next slide. The ASU has both presentation and disclosure requirements. The presentation requirement is to show contributed non-financial assets as a separate line item in the statement of activities. Showing the breakout between financial and non-financial contributions in a note disclosure is not allowed. Also, if the financial statement is comparative and the prior year didn't have the contributed non-financial assets on a separate line item, then the prior year's statement of activities will need to be reclassified. The ASU requires a quantitative disclosure of the amount of contributed non-financial assets received by category. The ASU also requires qualitative disclosures for each of the categories. These disclosures include information about whether the assets were monetized or utilized during the reporting period. If the assets were used, then you need a description of the programs or other activities in which the assets were utilized. If the not-for-profit has a policy regarding monetizing contributed non-financial assets, the policy has to be disclosed. If the entity does not have a monetization policy, you aren't required to disclose that fact in the policy note. If there are any restrictions placed on the use of non-financial assets received, the donor-imposed restrictions are required to be disclosed. The ASU also requires disclosure of the valuation techniques and inputs used to arrive at fair value measurement at initial recognition, and if the market used to determine the fair value is a market in which the entity is prohibited by donor restriction from selling or using the non-financial asset, the entity must disclose the market used. Next slide. Here is an example of a statement of activities. The line that is crossed out is the presentation as required under current GAAP and has been superseded by ASU 2020-07. The lines that are underlined are the required presentation under this ASU. Please note that this is just an example and you don't have to use the exact wording. You just have to use wording that means the same thing. Just make sure that at a minimum you have the presentation of the contributions of financial assets and non-financial assets on separate lines. Next slide. Here is another example which uses slightly different format. Here they have the header for contribution income with separate rows under that header for financial and non-financial assets. In this example, they call the non-financial contribution in kind. Next slide. Here's one more example. In this example, rather than showing the breakout of contributions between financial assets and non-financial assets on two separate lines, they're showing the breakout in columnar format. This format is not required. However, it is a good way to show how the non-financial assets are being used and how much of the non-financial assets were used. You may wish to consider this presentation if the amount of non-financial assets your organization receives is material to your financial statements. This example assumes that all the donated non-financial assets were received without donor restrictions. If there were non-financial assets received with donor restrictions, then the column for the donor restrictions would need to be changed to a 3-column format, just like the columns for the without donor restrictions. Although this presentation shows the amount of non-financial assets expense, that is not a required disclosure. Also, the ending inventory balance of gifts in kind received but not used is also not required. Next slide. There is no required format for the disclosures. We just need to make sure all the required elements are disclosed. I have provided examples, each using different formats. The first format has the quantitative disclosures in tabular format, followed by the qualitative portion in the narrative format. The second format has the qualitative and quantitative disclosures combined in a tabular format. This slide is the first format with just the tabular format for the quantitative disclosure. You can see here that they have 8 categories of contributed non-financial assets. The next 3 slides have the required qualitative disclosures, and you will see that the qualitative disclosures, they combine some of the categories into one paragraph. Next slide. This slide and the next 2 slides have the qualitative disclosures in narrative format. After that, I have an example disclosure with the qualitative and quantitative disclosures combined in tabular format. If this ASU is relevant to you, you can review these examples at a later date. Jennifer is up next with a discussion on goodwill and other intangible assets. All right, keep going.
Thanks, Lisa.
You're welcome.
A lot of good examples here. So hopefully people can use that since it's coming very quickly. Okay, so I'm actually going to start with the reference rate reform ASUs. So there were 2 ASUs related to reference rate reform. Many of you are probably familiar with the London Interbank Offered Rate, also known as LIBOR. There are over 300 trillion in certain debt and other financial instruments that actually reference LIBOR, which is a lot of money. And because it is the most widely used short-term interest rate in the world, it impacts many organizations. So originally, if you've been following the reference rate reform, LIBOR was set to be retired by the end of last year, 2021. However, some of those rates are going to be retired later than was initially expected. So the 1 week and the 2-month US dollar denominated LIBOR rates have actually already retired as of 12/31/21, which was on time. However, the overnight, the 1 month, 3 month, 6 month, and 12 month USD LIBOR rates are going to be published through the middle of next year, June 30th of 23. So those rates are going to be replaced by the secured overnight funding rate, also known as SOFR, I guess, because we love to use acronyms. And I just wanted to give a little bit of background on the change. So this has a little bit of background on what I just mentioned. And then the next slide discusses why is this being replaced. So because of the role that LIBOR played in exacerbating the 2008 financial crisis, which was quite a while ago now, there was a shrinkage in the number of banks that were calculating this rate that was used. So because the number of banks has shrunk since that time, there's a limited sample for calculating the rate, and the rate has relied on more and more expert judgment. There were also some scandals involving manipulation among the rate setting banks. So SOFR now is going to be the main replacement for LIBOR in the United States. It was established back a couple of years ago in 2018. It's based on the US Treasury repo market and is expected to be also the main global benchmark rate. So for those of you that have any debt instruments that have LIBOR, you may have already made the applicable adjustments to change those rates, but know that if you haven't already, it will be upcoming. So on the next slide, it discusses the first ASU, which is 2020-04. It impacts anyone, obviously, that has an instrument, a debt instrument, a contract, et cetera, that references LIBOR and provides some optional expedients if certain criteria are met which are abbreviated on this slide and discussed more in the ASU, but primarily relate to how contract modifications and lease modifications are handled and certain changes in the critical terms of a hedge. The next slide discusses ASU 2020-101. It applies to all entities that specifically have derivative instruments and also includes those optional expedients and exceptions in relation to the hedging agreements. Again, you can reference the ASU for some additional information related to those expedients as well. On the next slide, we have the effective dates. So ASU 2020-04 was effective for entities as of March 12, 2020, just over 2 years ago now, through December 31, 2022. There is a proposed ASU out there right now that is going to extend that date potentially to December 31, 2024, since, as I previously mentioned, there are certain LIBOR rates that will continue to be published through the middle of 2023. Feedback on that proposed ASU was just due last week, I believe, so that extension should be forthcoming. ASU 2020-101 was issued in January of 2021 and was effective immediately. And regarding the expedients and exceptions I mentioned earlier, those do not apply to any of the contract modifications made or hedging transactions entered into or evaluated after 12/31/22, except for those relationships that existed as of 12/31/22 when the expedients were elected. All right, moving on to ASU 2020-103, which is intangibles, goodwill, and other. So this ASU provides an accounting alternative to perform an entity's goodwill impairment triggering event evaluation as of the end of the reporting period, which is really nice. It only applies to goodwill, so other impairments over fixed assets, etc., are not in the scope of this ASU. As a result, any entities that elect this alternative are not required to monitor for goodwill impairment triggering events during the reporting period. So really simplifies that analysis. Instead, what you're going to do is evaluate those facts and circumstances at the end of each reporting period to determine whether a triggering event exists. And there's some examples of triggering events on this slide. And if so, whether it is more likely than not that goodwill is impaired. So those entities that elect this alternative shall also disclose its use of the alternative as a significant accounting policy in their financial statement. When was this effective, I should say? So on the next slide, we have the effective date. It's effective for fiscal years beginning after 12/15/19. So for 2020, 12/31/2020, early adoption was permitted. What's nice about this ASU actually is there is an unconditional one-time option for entities to adopt the alternative prospectively after the effective date. So if you didn't implement it and choose to adopt that accounting alternative in 2020, let's say, you can choose to adopt it in 2021, and you will not have to support that the alternative is preferable under topic 250, which is accounting changes and error corrections. Normally, you would have to have supporting documentation that that alternative is preferable over others. So it's really a nice option if goodwill impairment is relative to your organization. And with that, I think we're ready for our first polling question. Okay, so for periods ending on or after 12/31/21, the auditor's opinion will be the first section of the auditor's report. We actually haven't covered this yet, so this is a little bit of a test to see who is aware of those statements on auditing standards that were released a little while ago. So Some of you probably have seen these changes already, and if you haven't, you'll be seeing them very soon in your independent auditor's report. So, true or false? Give it another 15 seconds. Please get your answers in.
All right, get those last
Yeah.
last answers in. I'm going to close it out in a couple seconds.
All right. And the correct answer is true, 78%. Great job. Okay. Okay, so now we're going to dive into some statements on auditing standards and statement on standards for accounting and review services. First, we're going to jump into SAS 134 to 141. So the next slide includes the effective date of these ASUs periods ending on or after December 15th of 2021. Witham has actually adopted these standards for all audits with periods ending on or after July 1 of 2021. So you may, like I said, have already seen the new auditor's report, except for ERISA engagement. So if you're also involved in your ERISA engagement, that opinion has not been updated to SAS 134 yet. Those will be adopted as of the effective date. So on the next slide, we have some key changes that we just wanted to point out. We'll see an example of the new report as well. There have also been some additions to the auditor communications, to those charged with governance, in addition to the concept of key audit matters, also known as CAMs with a K. Again, we love those acronyms. What you're going to see is the auditor's opinion will now be required to be presented first within that independent auditor's report, followed by a basis for opinion section. The basis for opinion section, which is a separate section, will immediately follow the opinion section. It includes a statement in there that refers to the auditor's responsibility section, and a statement that the auditor is required to be independent of the entity. You'll also see additional responsibilities included in the report, which are not new responsibilities, but are really items that the standard setters felt were important enough to include for a reader to the financial statements. So moving on to the next slide, here's an example of the new independent auditor's report. Any items that are new have been highlighted. And if you're familiar with the pre-SAS 134 auditor's report, the first two paragraphs will look very familiar to you. The first paragraph is the current paragraph in the pre-SAS 134 report. However, it's now under an opinion header. And the second paragraph in that same section was previously the last paragraph in the pre-134 independent auditor's report. The second section I mentioned, the basis for opinion section, is new. There's two sentences that are not highlighted here that are currently in the auditor's responsibility section, again, of that pre-SAS 134 opinion. The highlighted amounts are the new language I just mentioned that refer to the auditor's responsibility and include more information on independence. On the next slide, we have management's responsibilities. There is now an additional paragraph here regarding management's requirement to evaluate going concern for 1 year after the date of the financial statements issued or available to be issued. Again, this is not new, just being highlighted now in the report. And then on the next and final slide of the example, we have auditor's responsibilities. So there's some additional items here. You can see they're highlighted. In the first paragraph, there's information now related to reasonable assurance, the risk of not detecting material misstatements and its relationship to fraud and error and material misstatements. There's a new bullet point list that we have here following the first paragraph, and there's information here regarding exercising professional judgment and maintaining professional skepticism during the audit, designing and performing audit procedures responding to the risks of material misstatement in those procedures, and a conclusion on going concern. And then you have the last paragraph here that specifically discusses the requirement for the auditor to communicate certain matters to those charged with governance, including the plan, scope, and timing of the audit, significant audit findings, and certain internal control related matters. So a few other items to note. One important change to the auditor communications with those charged with governance is the inclusion of an additional statement regarding uncorrected misstatements. So you're going to see that there's a sentence there that adds that uncorrected misstatements or other matters underlying those misstatements may be immaterial in the current year, but have the potential to be material in the future. Other changes to the letter, if they're applicable, include a separate section on significant unusual transactions, the addition of difficult or contentious matters for which the auditor consulted outside the engagement team, in addition to a separate section on CAMs. So what exactly are CAMs? This is a new concept which includes any matters that are most significant to the audit of the current period financial statements. They are also communicated to those charged with governance. It's not required. So it's only required if the auditor is engaged by the client via an engagement letter. If that engagement letter includes reporting on CAMs, you will not have a separate opinion on CAMs, but a description of each CAM will be included in the auditor's report. So on the next slide, we have an example of that language that would be included. The first paragraph includes what a key audit matter is, and then the auditor will describe each key audit matter in accordance with AUC section 701. Moving on to review engagement. So a few changes related to SARS 25. It's effective for periods, again, ending on or after 12/15/2021, can be early implemented. Witham, again, has adopted this for periods ending on or after July 1, 2021. So again, some of you have seen this. Really two key changes here. There's an additional sentence in the accountant's responsibility section of the review report related to independence and ethical responsibilities, similar to the change in the auditor's report that I mentioned earlier related to SAS 134. You'll see that in the next slide when we go to an example. And in addition, when the accountant determines that the financial statements are materially misstated, the standard allows the review report to be modified to include an adverse conclusion and a basis for adverse conclusion section. So on the next slide, we have a review report example. Here you'll see I highlighted the additional sentence that's been added related to that requirement of the accountant being independent of the entity. And then on the next slide, there's an example of a basis for adverse conclusion paragraph and an adverse conclusion. And now I'm going to hand it over to Stephanie, who's going to go through the last accounting standard update.
Thanks, Jen. Like she said, we're going to move on to the last section of our ANA update this afternoon, which is ASU 2016-13, covering credit losses for financial instruments. While this new standard will have the most significant effect on the financial service industry, particularly banks and others with lending operations, it will have an overall impact across most industries as this guidance applies to a wide variety of financial instruments, which is why we wanted to give you a high-level overview of the standard today. The purpose of the standard is to increase the accuracy and timeliness of expected credit losses. Examples of financial assets under the scope of this guidance include receivables. So these are going to be your trade receivables from exchange type revenue. So examples for nonprofits could be tuition or fees, membership dues, special event income, or merchandise sales. Notes receivable or other types of financing receivables such as loans, and held to maturity investments. Please note that contributions receivable are excluded from the scope of ASU 2613. So if you have pledges, if you're receiving pledges as part of your operations, this specific ASU doesn't apply to those pledges because it's scoped out. So what did this new guidance actually change? Under current guidance, organizations follow what's called an incurred loss methodology, meaning that a loss is recognized only after a loss event has occurred or is probable. For an example, most organizations will record an allowance for doubtful accounts based on management's judgment and experience. Under the new guidance, the probable threshold is removed. The incurred loss model is replaced with what's called the current expected credit loss model, commonly referred to as CECL. This requires management to accumulate and analyze past, present, and forecasted or future data to estimate losses. And at the time of the receipt of a financial asset, the organization will record an allowance or contra asset to arrive at the net amount expected to be collected. This ASU is effective for periods beginning after December 15th, 2022. So that's, if you're a calendar year end, that's 2023 for you. Early adoption is permitted, and the modified retrospective method of transition is required. And that brings us to our next polling question. And Brittany, I have the polling question here, but I'm not able to see it because I'm sharing my screen. So if you could help me kind of monitor the poll. ASU 2016-13 financial instruments credit losses is effective for which type of financial asset? A, trade receivables for items such as tuition, membership dues, and merchandise sales. B, investments accounted for at fair value. C, contributions or pledges receivable. Or D, all of the above.
All right, we're about halfway there, so we'll give it about 15 more seconds to get those last answers in.
Okay.
All right, get those last answers in when we close it out. Alrighty, so it looks like we have 38 responded A, trade receivables, 6% investments accounted for in the fair value, 3% contributions receivables, and 52% said all of the above.
Well, those that picked answer A got it right. Trade receivables fall under the scope of ASU 2016-13. All right. So this concludes our A&A portion of the presentation, and now we're going to transition to the next section, which is avoiding common accounting pitfalls. These are some areas where we commonly see confusion with our clients, so just thought we would give a refresher. The first topic is revenue recognition, specifically how to know the difference between a contribution and an exchange transaction. So here we have our technical definitions of these concepts. An exchange transaction is a reciprocal transfer in which each party receives and sacrifices approximately equal value. A contribution is an unconditional transfer of cash or other assets, as well as an unconditional promise to give or release of liabilities in a voluntary, non-reciprocal, and that's an important word, transfer by another entity acting other than as an owner. This table is a good point of reference for some of the main differences between an exchange transaction versus a contribution. And two of the main things I wanted to point out here are, first of all, an exchange transaction is one in which commensurate value is received, with the two parties receiving the direct benefits of the transaction. With a contribution, often or generally a third party, such as the general public or another subgroup, is receiving the benefits from the resource provider. So in other words, there's no commensurate value between the two parties. And second, in an exchange transaction, you can see contracts with provisions for punitive damages to penalize non-performance. However, with a contribution, you'll see that contract penalties are typically limited and are not punitive in nature. So you'll see things such as returning unspent grant funding. And next, we have a few examples from guidance that we can walk through to determine whether a situation is an exchange transaction or a contribution. So our first example is a nonprofit that's a large research facility with a cancer research center. Funds from a pharmaceutical company are received to finance the costs of a clinical trial. The pharmaceutical company dictates the number of participants to test, the dosages, and the frequency, and requires detailed reports of test outcomes. And finally, the drug is owned and created by the pharmaceutical company. So is this an exchange transaction or a contribution? It is an exchange transaction. That's because the results of the trial have commercial value for the pharmaceutical company, and the pharmaceutical company is receiving direct commensurate value as a result of the transaction. Our second example, a local government provides funding to a nonprofit to perform a research study on the effects of a longer school year. The nonprofit is required to plan and perform the research and submit reports to the local government. The government retains all rights to the study, so it can't be published without their consent. So is this a contribution or an exchange transaction? It is an exchange transaction because the rights are retained in the study by the local government. And that is our threshold, our barrier for commensurate value being exchanged. And we have one final example. The federal government awards money to a university. OMB rules must be followed and unspent money must be returned. The university retains the rights to the findings and has permission to publish the findings. So that last bullet point I think is important. Is this an exchange transaction or a contribution? It's a contribution because the federal government did not receive direct value from the university because they're retaining the rights to the research and the findings. And also the public is receiving the benefit of the study, not directly the federal government. So now that we've walked through some examples of exchange transactions versus contributions, how do we account for these transactions once we determine their nature? In the case of an exchange transaction, you're going to follow ASC 606, which I think everyone should have implemented by now. That's revenue from contracts with customers, and it uses a 5-step model for revenue recognition. We won't go into detail here, but just as a refresher, the 5 steps are to identify the contract with a customer, identify performance obligations, determine the transaction price, allocate that transaction price across the performance obligations, and finally, recognize revenue as performance obligations are satisfied. And alternatively, if you determine that you have a contribution on your hands, you're going to follow the guidance of ASU 2018-08. This was sort of a tag-along ASU to go along with ASC 606 that we just discussed, because contributions are specifically scoped out of 606. Under 2018-08, revenue recognition is a 2-step process. The first step is what we just talked about on the previous slides, determining whether or not you have an exchange transaction or a contribution. For the exchange transaction, you're going to follow ASC 606. If you have a contribution, you're going to move on to step 2. Step 2 is to determine the existence or lack of conditional contributions, which determines the timing of revenue recognition. And note, both of the following criteria must exist for the contribution to be considered conditional. A specific performance-related barrier. And specific is the key word here, as we'll see on some future slides. Also, a right of return or right of release for the contributor exists. So let's walk through this process with a few more examples. Example number 1. A nonprofit receives a private grant of $400,000 to provide career training to 8,000 disabled veterans during the next year, with minimum requirements for each quarter. The grantor will provide $100,000 per quarter upon the nonprofit's demonstration that it trained the minimum requirement for the quarter. So, do we think that this is a conditional or an unconditional contribution? It is conditional, largely because there is a measurable performance-related barrier of 8,000 veterans needing to be served over the next year. There's a right of release from obligation if the nonprofit isn't able to meet that threshold, and we're going to record revenues each quarter as the barrier is overcome and satisfied. Next example. A nonprofit is a hospital that has a research program and received $300,000 of grant funding from a federal agency toward thyroid research. OMB rules apply for allowable costs. The grant is on a reimbursement basis, and under the terms of the grant, unspent funds are forfeited and unallowable costs must be refunded. And this, again, is a conditional contribution. And this is because the nonprofit has limited discretion over spending due to the OMB guidelines. That's our barrier. And then there's a right of return for funds spent on unallowable activities or unspent grant funds. And our third and final example, a nonprofit is a public charity that works with gluten-related allergies and received $100,000 from a corporate foundation to perform research. A budget must be followed and any significant deviations must be approved. A cost report must be submitted at the closeout of the grant. Also, a right of return exists in the grant agreement for unused or misallocated funds. So, do we think that this is a conditional or an unconditional contribution? It's unconditional, largely because no right of return exists, but also because there is no barrier. The monies align with the nonprofit's mission, and there's no specific barrier. If you think back to the veterans example, they had to serve 8,000 veterans in the next year. There's nothing specific like that in this example. And general budget and reporting requirements don't typically meet the criteria of a barrier because general administrative aspects of grants don't constitute a barrier. But quickly, I just want to go back to the previous slide just for a moment because I want to tweak the situation slightly and highlight the difference between a restriction and a condition because this is a common area of confusion. Oftentimes, we have these discussions with our clients and have to provide some additional information. So I thought it would be a good area to highlight. So under that first bullet point, the foundation provided funding for gluten-related research. That is a general condition in nature, and so it doesn't constitute a barrier because, as we discussed, it's in line with the organization's mission and there's no specific performance-related barrier. What if we change the wording to say, perform research on gluten-related allergies in children under the age of 5? There's still no measurable performance-related barrier to overcome, but because the funding is supposed to be used for a purpose that's more narrow than the overall mission of the organization, it should be classified as a restricted contribution in the period received, and the net assets will be released from restriction in the period that they are used for the donor's specified purpose. And with that, I think I'm going to hand it back over to Jen for net asset classifications.
All right, thank you, Stephanie. Okay, so I think one of the biggest areas that have common accounting errors that we see includes net assets and the related classification. So this isn't, the next slide is not an all-inclusive list, but it includes some of the more common issues that we see. So the first relates to errors in endowment calculations. Those endowment calculations are typically performed in Excel spreadsheets and can be prone to human error. So an incorrect formula could be used or things could be copied incorrectly. So really double checking those calculations and those numbers is a key component of the endowment. In addition, there could be errors regarding reporting. So really validating the amounts that end up in the endowment footnote. For example, making sure that the contributions in that footnote are cash amounts that were added to the endowment, validating the split between with and without donor restriction related to your investment return, making sure that's correct. And there are really a slew of endowment disclosures that are required, and there may be some missing. So just double checking to make sure the notes to the financials include those disclosures. So for example, underwater endowments, formerly before the presentation of not-for-profit ASU, all you needed to disclose was the underwater amount in the aggregate. Now, in addition to that, you are required to disclose the original gift amount in total, the fair value in total, and the organization's interpretation of its ability to spend and the policy and any actions that it took during the period concerning appropriation from underwater endowments. So really focusing on your disclosures, making sure they're complete. Negative balance in net assets with donor restriction. I've seen this a couple times. You can't release more than the total of the balance for that purpose restriction. So make sure you're reviewing your net asset detail, validating that none of those amounts have gone negative. Unfortunately, you can't spend more than you have. So the next item relates to recording board designated net assets. They should be in net assets without donor restrictions. We've seen them in with donor restrictions, and maybe the confusion is that the board can designate assets for certain items and programs, but they're not a donor, right? So they have to stay in without donor restrictions. I'll touch on pledges receivable in the next section, but for receivables or payables due in future years, they should be classified as with donor restriction because you inherently have an implied time restriction because you have not received the money. So making sure that those are recorded as with restriction instead of without donor restriction is key. Reclassifying items between net asset categories should only occur when there's a change in donor designations. Sometimes there's errors that are caught. In most cases, hopefully they're immaterial and you just have a non-GAAP item or a past reclass entry. If it's material, you could be looking at a restatement, but just making sure you're double checking those items when you're recording them. And changes in the donor designation do happen. Donors change their minds, or the organization can go back to the donor and ask that the restriction be released. Just a reminder that expenses must be included in net assets without donor restriction. You will never have expenses in net assets with donor restriction. And lastly, we have seen instances of organizations not releasing restrictions in accordance with the first dollar rule, also referred to as the deemed spent rule. So what exactly does that mean? Well, according to the first dollar rule, when expenses are incurred that satisfy the donor's restriction, you've met the purpose, regardless of whether the restricted assets were actually spent from that donor specifically. So it doesn't dictate the timing of when management must expend the source of funds, but only really to determine for financial reporting the point at which net assets with donor restrictions are released from restriction to net assets without donor restriction. So just a quick example, for example, if a hospital purchases a $5,000 crib for its NICU unit, neonatal intensive care unit, using board designated net assets, which are without donor restriction, as I just mentioned. At the time, the hospital had donor gifts of $10,000 that were restricted for the NICU. So for financial reporting purposes, the purchase of the crib triggers a reclassification from restricted net assets to net assets without donor restriction. So even though the hospital opted not to use the funds that they received from the donor, you cannot avoid recognizing the reclassification simply because you chose to use unrestricted resources for the expenditure. So just wanted to point that out. I think some people tend to forget that. Moving on to present value, just wanted to highlight a couple key items. Time value of money is really what it is. So any contribution that's received, for example, contributions receivable and contributions made. So if you have grants payable, if you're a grant making organization, should be recognized at net realizable value. So any amounts that are expected to be received or paid after 1 year need to be discounted to present value, utilizing an appropriate rate. So the rate that you end up using should be determined at the time the amounts initially recognized. And you should not be revising that rate unless you have elected the fair value option under ASC 825. So what does that mean? So you're going to end up with what I call a layering of rates if you have multi-year pledges in multiple years. So if you received, for example, a pledge in 2019 that goes till 2023, and then another one in 2020, the rate may not be the same because it needs to be recognized when you initially recognize that pledge. So just keep in mind that's typically why when you have the disclosure, which we'll talk about in a minute, you'll have a range of rates. So I think it's fairly easy to keep track of the dates, but if you have that well-organized pledge schedule, but just keep in mind that it's not a rate that's going to be updated every year end. You're going to really need to look at the detail of your pledges and keep track of when those were recorded. The discount would then be amortized into revenue in the appropriate net asset class. And just a reminder, as I mentioned, it also applies to contributions made. So if you have grants payable expected to be paid after 1 year, your multi-year grants, that would also apply. The next slide just has the typical disclosures related to present value. So you'll have your contributions receivable, for example, due within 1 year, then a line for 2 to 5 years and thereafter, followed by the present value discount and any allowance if you have one, and a subtotal for your net amount. So that will ultimately tie back to your amount on the statement of financial position. You have the option of also presenting it, the discount separately on the statement of financial position. I don't know that I've ever seen that. I think it's much cleaner in the actual footnotes, but you can do that if you would like to. And the footnotes should also include your rates used. So again, that range of the rates. And now I think we're going to move into our third polling question. All right, conditional contributions must have a specific performance-related barrier that must be overcome in either a right of return or release. Please select true or false. All right, I think we have one question. Let me see if I can answer it while everyone's wrapping up. Pledge receivables you record with restriction and release once you get the payment. So in theory, yes. So anything that's in receivable at your end has a time restriction because you haven't received the cash yet. Once you get the money, your time restriction is met. However, if there's a purpose restriction as well, you cannot release it until you've met that purpose. But if it's just a pledge, someone's going to pay for, a general purpose related to the organization, and you have 5 years, each year you get it, you would release that money, correct? Hopefully I've answered that question. Let us know if you have another question. All right. So 96% said true. You are correct. All right, and now the last section I'm going to be handling functional allocation of expenses. Make sure you have an established and well-documented methodology that's supported, including how you're determining those allocations. So on this slide, I just wanted to highlight prior to ASU 2016-14, which again was that ASU I mentioned earlier, certain expenses may have been allocated across program and supporting services. However, there was clarity in that ASU that certain expenses that support the entire organization should be classified as management and general only. So for example, employee benefits management and oversight provided by HR, in addition to payroll. So any expenses that relate to direct conduct or direct supervision, or essentially program and supporting, should be allocated from management in general to the activities benefited. So for example, if your CEO spends a portion of time directly overseeing a research program or a certain program in your organization, and a portion of their time with current and potential donors on fundraising, then some of his compensation would be allocated to the research program and to fundraising, representing the time spent on those activities because they reflect direct conduct, direct supervision. If the remainder of his or her time is spent indirectly supervising other areas, so administrative areas, those would not constitute direct conduct or supervision, and the rateable portion of compensation would remain in management in general. So just something to remember. Same could apply to the CFO, your grant department as well. Just a reminder, there are required reporting related to function and nature, should all be in one location. So it can be on the statement of activities as a separate statement, which I think is what we typically see, a statement of functional expenses, or in the notes to the financial statements. It's required to show the relationship between functional and natural classifications in that analysis. That really disaggregates the functional classifications. So you have your major classes of program services and supporting activities. And it's possible that you could report just one program activity in certain situations, but you can disaggregate if you have separate objectives within your entity's programs, or your nature of your organization's services differs. A reminder on expenses that go on the functional expense statement, or expenses that end up being functionalized. So investment expenses are netted against investment return. They are excluded from your functional allocation. There are also certain expenses that are netted against revenue and can be incorrectly excluded from your schedule, including, your special event expenses, costs of goods sold, etc. So in summary, all expenses reported in revenue are included in the functional expense analysis, except for investment expenses. And again, just a reminder on disclosures, there should be a description of any methods used to allocate costs among program and supporting. So here I have, square footage for depreciation and amortization, estimates of time and effort, etc. I think typically this is done in a table format. I think that's the easiest way, but as long as it's disclosed, you can do it how you'd like. All right, and with that, I'll let Lisa just wrap up quickly on accounting for donated non-financial assets.
Okay, you can go to the next slide. Another area where we see accounting errors is in recording donated non-financial assets. When a not-for-profit receives donated goods, it needs to determine if the transaction is a pass-through transaction, which would be treated as a liability on the statement of financial position and never ends up on the statement of activities, or if the transaction should be recorded as revenue on the statement of activities. This slide is just a reminder of these rules. In order for a transaction to be recognized as revenue, the not-for-profit recipient entity must have discretion or variance power in using or distributing the gifts in kind, especially in cases when the donor or grantor has specified particular beneficiaries. Variance power is defined as the unilateral power to redirect the use of the transferred assets to another beneficiary. Unilateral power means the recipient entity can override the donor's instructions without approval from the donor, specified beneficiary, or any other interested party. Also, in order to record contributed goods as revenue, in addition to variance power, using or distributing the gifts in kind, it also has to have the risks and rewards of ownership of the contributed goods, such as the risk of loss if the goods were lost or damaged or destroyed. It's also the ability to obtain the benefits of and control others' access to the gifts in kind. This usually involves taking physical possession of the assets, but sometimes there is constructive possession, such as when the item is housed in a third-party warehouse. In order for an entity to record revenue, the transaction must meet both the criteria. If it only meets one criteria, then the transaction is an agency transaction and revenue is never recognized. Brittany, I know we're past our time. Do we want to do that last polling question now? And then I can go through the last few examples after the polling question?
Sure, I'll launch it right now.
All right, so the question, true or false, contributed services are recognized as revenue when they create or enhance non-financial assets? And Brittany, how are we doing with responses?
I've got about 30, a little over 30. It's rising quickly, so I'll give it about 15 more seconds. All right, get those last minute answers in. I'm going to close it out now.
Okay, and 75% of you did get the correct answer. However, contributed services are also recognized as revenue if they require specialized skills, are performed by those people with those skills, and would typically need to be purchased if the services had not been donated. So you guys now have all of your polling questions answered. If you do need to hop off, because it's 1 o'clock now, you can. If you want to stay, I'm going to go through the last few examples that I have in here. So Stephanie, if you want to go back to slide 75, which is where I left off, I will continue on with my part of the presentation. So I'm going to go through some examples on how contributions to non-financial asset transactions should be recorded. But for the first example, assume a not-for-profit entity has a program where they distribute drugs to hospitals throughout Haiti. They received the donated drugs from a donor that said the drugs have to be provided to a particular hospital. How would this transaction be recorded? You can go to the next slide. In this instance, since the not-for-profit doesn't have the ability to determine which hospital will receive the drugs, the receipt of this asset will initially be recorded as an asset and a liability, and then when the drugs are provided to the hospital, the entry will be reversed. Moving on to the next example, assume the same facts as in the first example, but this time, although the drugs are restricted for use for a particular hospital, the donor said that if the not-for-profit knows of another hospital that has a greater need for these drugs, the not-for-profit can give the drugs to the other hospital. The not-for-profit also has the risks and rewards of ownership of the drugs. How will this transaction be recorded? All right, so the answer is on the next slide. In this case, the not-for-profit has the discretion to redirect the drugs to another hospital and has the risks and rewards of ownership. Therefore, the not-for-profit would recognize an asset and contribution of non-financial asset income for the fair value of the drugs received. When the drugs are distributed, the not-for-profit would recognize an expense. Moving on to the next example. All right, not-for-profits sometimes receive discounts on their purchases. Sometimes these transactions are part exchange and part contribution. The next couple of examples will cover when a bargain purchase price would be considered a contribution. Assume that a private school starts a capital campaign to construct a new library. They hire a general contractor to build the library. The contractor charges 70% of their normal rates to construct the building. Through the competitive bidding process, it was determined that the discounted price is equal to the market price that not-for-profit entities would pay for this project. Did the not-for-profit receive a gift in kind equal to a 30% discount? And the answer's on the next slide. The not-for-profit did not receive a bargain discount since the price they are paying is the market price charged to not-for-profit entities. The entire transaction is an exchange transaction. We've got another example on the next slide. This time assume the same facts as in the previous example, but this time assume the contractor gave the private school a 50% discount. Did the private school receive a gift in kind equal to the 50% discount? And the answer is the private school did not receive a gift in kind equal to the 50% discount. Since the market price charged to not-for-profits is a 30% discount, the private school received a gift in kind equal to a 20% discount, which is the difference between the 30% market discount received by the not-for-profit entities and the 50% discount that the private school received. The value equal to the 20% discount would be recorded as contribution of non-financial asset income, and the other side of the entry would be a debit to building. So those are all of my examples, and we are now done. And I don't believe there's any more questions. I didn't see any. So I want to thank everybody.
Either.
Just want to thank everybody for attending the session today.
Yes, thanks. And as always, you know, if you have questions, reach out to your auditor. And if you have any questions, our contact information is here as well. So thank you, everyone. Thank you to those who stayed, and have a great rest of your day.
All right, thank you everybody for joining. We will be sending a follow-up email with the PowerPoint presentation and the webinar recording. If you can just please take a moment to fill out the post-webinar survey. Thanks again and have a great day.